Have you ever wondered how professional traders consistently predict market trends and maximize profits? Stick around because in this video, I'm going to reveal the secrets behind mastering the MACD indicator that could transform your trading game forever. Welcome to Forex Fundamentals Pro, where we not only educate you, share trading strategies, we also offer optimized tools to give you a real edge in the market. So let's get started. In this video, we're going to be discussing the Moving Average Convergence Divergence Indicator, or MACD for short. The MACD is a trend-following momentum indicator that can consist of the MACD line, the signal line, the level, and the MACD histogram. The values of these components represent different aspects of market momentum and trend direction. On this chart, we have three windows. In window one, we're depicting price, where we have bearish candles depicted in red, showing that price is falling. And we have bullish candles depicted in blue, showing that price is rising. In window two and in window three, we have two identical MACD indicators. The only difference is in window two, we have the standard MACD, and in window three, we have the FFP optimized MACD indicator. We'll go over the difference later on. The MACD, as we shared, consists of multiple components. The standard MACD, we right-click on the property section, will show you that it typically uses the 12, 26, and 9 parameter settings. These are different moving averages that make up the MACD indicator. And white is the MACD histogram bars. In red, we have the signal. And if we click on the levels tab, we'll see that we have the level depicted by the horizontal aqua line. You can add another level if you so choose. Now, the histogram bars, if the histogram bars are below the level, meaning level 0, if we go over to the far right, we'll see that level 0 is right here. So we have the histogram bars, which are the white bars, below level 0. The trend is a downtrend. Price is trending down. Take a look at price. Overall, we see price falling. If the histogram bars is above level 0, say you're like right here, then price is trending up. So the histogram bars allow us to see clearly whether price is trending up or trending down. Now, the histogram bars in relation to the signal line, meaning the white bars and the red line, if the histogram bars are below the red line, then we have bearish momentum. If the histogram bars are above the red line, the signal line, we have bullish momentum. So we can be in a buy trend, but have bearish momentum. And as you can see up above with price, we in a buy trend, but then price pulls back with bearish momentum. And then if we get above the signal line, then price is pushing back up again. And you can follow that along with the MACD. above, below, above, below the signal line. Same holds true if we were in a downtrend. If we are in a downtrend, then essentially, if the histogram bars are below the signal line, then price is trending down and we have bearish momentum. If the histogram bars is above the signal line, price is pushing up and we have bullish momentum, although we are in a downtrend. Pushing up, pushing down, pushing up, pushing down, pushing up, pushing down, and so on and so forth. So understanding that should give you some clarity on what price is doing trend-wise, and if price is potentially going in the direction of the trend or going against the trend. Now, it could be easily assumed that once the histogram bars fall below the signal line, that we could sell the market. And once the histogram bars go above the signal line, we can buy the market. Well, the MACD indicator is not one size fits all. It's not foolproof. And it's just not that simple. In concept, yes, price is pushing down when the histogram bars are below the signal line, and prices pushing up, or we have bullish momentum when the histogram bars is above the signal line. But if we take further look at what is happening here, we can see that if we take a vertical line, let's say on this particular bearish candle, I'm going to change the line to yellow and make it a little thicker so we can see it. On that particular line, we can see that this is the lowest price has been thus far at this point. But if we look at the histogram line on that particular candle, that's where it stopped. But we can see the histogram bars continue to go lower while price started to push up. The MACD indicator, again, is a trend following momentum indicator, which means that it actually is a lagging indicator. Just because the histogram bars went below doesn't mean that we ought to just sell. Or just because the histogram bars went above the signal line doesn't mean that we just buy. It's signaling us a direction. It's giving us an indication of what price is doing, but we must use additional confluences, tools, what have you, to get an overall bias or direction of the trade. We shall also take in consideration support and resistance, even Fibonacci extension levels, even swing highs and swing lows. For example, if we now come over to this guy right here, we can see that the histogram bar is almost in line with the histogram bar on the other side, on the left-hand side. And again, price fell, well, the histogram bars went lower, but price started to push up. So in this case, if we were considering taking a trade for this particular instrument, and we identified that we were in a sell trend or price was trending down because our histogram bars is below level 0, and we identified also that our histogram bars were going above the signal line, we would have to wait for either the histogram bars to go below, which could be a late entry, or we could wait for price action where we get a reversal signal based on price itself. Because if we waited for the histogram bars to go below the signal line, let's say if we waited to right here on that particular histogram bar with that particular candle, we would have been right here at the end of this candle when this candle closed. And it would have been too late. Because you think about the moving average, the average goes up and you get a signal once price have already moved up. In order to increase the average of something, you need larger numbers first, and then you can now see that price has moved up. So if you was to get the histogram bars going above the signal line, price, of course, would go up first, and then you would see the histogram bars going above the signal line. So price already started going up first, then the histogram bars got above the signal line. And the same happened over here where price start to go down first, and then we see the histogram bar get below the signal line. But you want to actually consider a trade prior to the histogram bar actually showing its face or getting below the signal line, because by that time, price has already moved south.
Exactly. Exactly.
And the truth shall set you free.
So in the event that we see the histogram bars going above, meaning that price is now pushing back in its overall downtrend, we want to look for a reversal signal that tells us that price is potentially going to go back down. So as we're pulling back up, we are looking for some type of confirmation, such as, here we go with a candlestick reversal pattern. We have price, showing its face with a bearish candle, and then the series of bearish candles engulf that bullish candle. That's a reversal signal. Okay. If we look a little closer, we can see that this particular candle and the candle that came after the bullish candle actually sort of an inside bar situation where it fit in between the two, although this bar is larger than this bar. So it could be a combination of almost an engulfing candle inside bar, but this is further confirmation when this particular candle closed below both of these, and this was an engulfing situation. So from there, that was a reversal signal in this overall downward trend, because the histogram bars are below the double zero level, which is the aqua line. And therefore, we could consider taking a trade back down. We also have a second area right here where we have an engulfing candle situation. That's another signal of price pushing down. So in both of these cases, we could have took a sell before the indicator actually had a histogram bar go below the actual signal line right here. So we could have actually caught all of these pips. Okay. So identifying your trend first, waiting for price to retrace, and then receiving a signal is the step-by-step method one should follow. We'll say it again. Identifying the trend first, waiting for retracement, and then getting a signal is the steps we want to follow in order to take trades that are more favorable in our direction, where we actually will be risking less than we will be going after. So in this case, if we took a trade after this particular candle right here closed above our swing high, would have been about 91 pips or so. our swing low was at 320 pips. And as we can see, we would have got every last one of those pips had that been our entry point. Right here, after this candle closed, and we started on this candle for the sell, we could even consider that particular swing high or high, 77 pips. Above here is 138 pips. And then down here is 271 pips. And again, we would have got every last one of those pips had we followed those steps. So the way you could use the MACD is leveraging the histogram bars in relation to the signal line, identifying the trend, waiting for retracement, getting the signal, and then going for the sell. That's in a downtrend. We look at an upward trend, buy trend, where the histogram bars are above the level 0. In this particular case, we would do the same thing, just for a buy trade. So here we have the histogram bars above that's showing bullish momentum. We are in a buy trend because the histogram bars are above the 0 level, the aqua line. Now our histogram bars are going below the signal line, excuse me. And that's sign of retracement. We're still in a buy trend, but our price is retracing. Price is retracing. So what we would do is we would wait until we get a reversal signal that signals price is looking to change direction. So here we go with a inside bar or Arami, in which if price closed outside above this level, then we could consider a buy trade. And as we can see, right here is where price actually closed outside above. Inside this box, we have what we call indecision. Price closed out above. We're in a buy trend. Price just retraced. Now it broke outside the box, and we can actually place a buy trade back to our swing high. Stop loss below our swing low. Take profit at our swing high. Same concept. Let's see what would have been the results as far as risk to reward ratio. Right here, if we took this trade after this candle closed, then our stop loss is below this level, 104 pips or so. Take profit would have been 157. So we about 1 to 1.5 risk to reward. And that would have been our entry right there. And if we step through, we have histogram bars above the signal, came back again, looking for some type of reversal signal. Pin bar is a great reversal signal, which we could have leveraged. Consider the trade. If we needed further confluence, just wait for another bullish candle above it. Okay, but in this case, right after the pin bar, below there, we have 66 points, TP 144 points. So about a 1 to 2 risk to reward ratio. Swing low, swing high, TP smashed. Now, you can use your swing low or swing high, depending on the direction of your trade, as your TP. You can use support and resistance as a TP, and you can also use a Fibonacci extension levels, which we go over that in another video. where price pushed up. And then it pulled down. So we have price pushing up right here, then pushing down, and use our Fibonacci, and then could have told us where price is likely to go. So leveraging the MACD and understanding how it works can be very favorable to your trading. Now, what you also want to take in consideration is the type of trader that you are. Right now, we're actually looking at the 4-hour time frame. Now, if you are a swing trader, aka long-term trader, you want to stay in the market and get the overall move, let's step back a little. As we looked at before, when we were in a sell trend, right here, where the MACD histogram bars got below the signal and below the 00 line, it stayed below there, a swing trader would have looked for an entry, for a sell, and would have stayed in the trade so long as the histogram bars stayed below the 00 line. Okay. So right here is where the histogram bars started to go above the level 0. And the swing trader would have gotten all the pips, all the profit from this point on down. We're going to zoom in and we're going to look at it right here. So this would have been the swing trader move right here. So don't get confused because you have some MACD bars that are higher than others, but it's still in a downtrend. So right here we have MACD bars this high, then we have them lower, and then we have them higher right here. But price is still pushing down because we are overall still in a downtrend. Now, a swing trader on the other side in a buy trend essentially would have done the same with the MACD histogram bars getting above the 00 line. So long as it was above there, they would have held their position until the MACD histogram bars got below the 00 or until they broke structure. So structure is a whole nother lesson we'll talk about in another video. So right here, this would have been maximum pippage for the swing trader. 493 or so pips if they got out, although the histogram bars got back above the 00 and it kept going up. We didn't actually have a break in structure. So if they were advanced enough and seasoned enough, could have stayed in or took partial profit along the way. So it depends on your skill level and your level of understanding on whether you should stay in the market, or exit the market, and when to enter the market and when to exit the market. But for simplicity and clarity, when we looking at the MACD, histogram bars below level 0, we're trending down. Histogram bars above level 0, we're trending up. Bullish momentum, histogram bars above the signal, whether we were trending down or trending up. Histogram bars below the signal, we're trending down. We have bearish momentum, no matter if we are trending down or if trending up, we have bearish momentum. Okay. Now, with that being said, sounds simple, easy peasy, practice, practice, we can figure it out. But there's a problem. There's a problem. And we're going to get into that problem right now. We are often told how the MACD works. And once understood, it seems easy peasy. But in reality, the difference is it's not realistic that you'll actually be on the charts when the MACD histogram bars get above the signal, MACD histogram bars first get below the signal. Okay?
Facts.
When the MACD histogram bars get above the level 0, or the MACD histogram bars get below the level 0, those are the most ideal levels and areas to be at the charts. Well, aside from that, one thing we haven't went over was why is it called not only convergence, meaning going in the same direction, but also divergence. MACD is the moving average convergence divergence indicator. It lets you know when price is converging with an indicator, oscillator, or when price is diverging from an indicator, oscillator. So we look at, say, this level right here. We're going to look at this level right here. And we're going to look at this level right here. You see that price is higher at the first point and lower at the second point. If we look at the MACD around that same area, price is lower at the first point. I should say that MACD histogram bars are lower at the first point and higher at the second point. That is considered divergence. That's considered divergence. When we have price falling, but the indicator / oscillator is not. That's divergence, going in two completely different directions. When you have divergence, chances are price eventually is going to turn in the direction of the oscillator. So in this case, if the oscillator is pushing up, ultimately, eventually price will push up. Not always completely reversal, but at least a correction. Okay. And then price and the oscillator can get back in sync with each other. But it's actually an indication that price is going to reverse. There's really no more selling pressure in this situation. The buyers are taking over and push price up. So not only does the MACD help us identify the trend direction and the momentum of price, it also helps us identify when we have divergence. So that's one thing. The other thing is, yes, we will not likely be at the chart unless you're staring at the chart 24/7 to know when these key scenarios happen. The MACD histogram bars get above the signal, below the signal, or above the 0 or below the 0. Therefore, we have our FFP MACD signal crossover alert indicator, which is right below. It looks exactly as the standard, but the standard is missing the MACD line. The MACD line essentially is the MACD histogram bar represented by a line as opposed to bars. So that's one thing that the standard MACD is missing. The standard MACD is also missing the bells and whistles that the FFP MACD signal crossover alert indicator has. Let's take a look at it. If we wanted to know when the MACD line and signal line cross, all we would like to do is actually first represent the histogram bars as a line. So what we want to do is show the MACD as a line. Hit OK. So now you see that along the edge of the histogram bars is a yellow line. That's the MACD line. Now we can actually visually see the MACD and the signal line actually cross. We can actually see where it actually crosses at. So we can not only look at the yellow and red MACD and signal line to see where they cross, we actually can go into the parameter settings and we can actually put arrows on the chart by setting the show arrows at line crosses to true. And voila, we actually have arrows pointing wherever we see the MACD and signal line cross. So using the same technique, if we are in a downtrend and MACD histogram bars is above the signal, we now actually can see when the MACD crosses back below the signal. And that's not all. Not only can we get an arrow, we also can get an alert via a mobile device, via our trading device, via email, and via sound. And wait, that's not it. We also can identify when the actual MACD bars, histogram bars, go above and below the 00 line.
I'm sorry, what?
Again, all we have to do is go into the settings by right-clicking on our MACD, and we want to show when the MACD actually goes above and below the 0 level. So now we can be alerted, get a visual, and see when we go into that buy trend from that sell trend. But again, the MACD itself is not foolproof. We need to understand support and resistance. We need to understand candlestick anatomy with price action, swing highs, swing lows, and structure. Lastly, I would like to share that we don't have to stick with just the 0 level to determine if we are in an overall buy trend or sell trend. As you can see right here, the MACD has come above the level 0. Right here, we also have where the MACD came above the level 0, and then it pushed back down. You have an area right here as well. So can't just say because the MACD histogram bars went above or below the 0, we're automatically in the sell trend or a buy trend. Okay, which you can do to get clarity and further consistency and less false breakouts, false signals, is to identify an area which I call trapping the MACD. How we would trap price, and we choose an area, the same area that we choose above the level 0, we would choose below the level 0. And what we're trying to do is we're trying to see where is it within this range, say with this red horizontal line above the level 0 and below the 0, where we get what we would call price just ranging. You see, say right here, price is really not going anywhere but sideways. You see our MACD right here? It's essentially as high as it got at this level, then it pushed down, although price seems like it's pushing up. So if we're at a point where we have the MACD in this range, it's really not going lower or necessarily higher in this area. It's just ranging. And we want to know when we go into the real highs. And if you follow here, we know once we're above this level, we're going to a real high. We're going to a real low. We're not going higher than the previous high in this area. Okay. So you can look at where do you see price ranging and trap it within a range in the MACD. Okay. Now, what I would do is I like to pick a whole number. So looking at the numbers over here on my right, we have 0.1920 and negative 0.23. I would do a range like 0.25. So I'll set on both sides a range of 0.25. Above the level 0 and below the level 0. So this would be -0.25. And I'll lock that in by double clicking on the lines. And what I would do is say, okay, I would consider myself in a true buy trend if the MACD histogram bars got above this level 2.5. As you can see, the price right here is pushing up higher and higher. That's because the histogram bars are higher and higher. We above that level. Okay. So this price point got lower than this price point as we came out of level 0.25. Okay. This price point actually was lower than this. So we identified this as divergence, but at the same time, just let me know that price could get lower than the previous low because we were below the level 0.25. So now like price is pushing down lower. So that's a little hack, a little trick. If you didn't know that, hopefully you learned something by this of how to leverage the MACD. By all means, get a copy of our FFP, MACD, and signal crossover alert indicator so that you can get an edge in the market by leveraging the MACD. We can identify when we are in a sell trend, when we are in a buy trend. We can identify when we have bearish momentum in a buy trend or bullish momentum in the sell trend. And we can have a leg up in the market. Hopefully you learned something here. If you have any questions or comments, by all means, put them in the comment section below. Click subscribe, give us a thumbs up or a thumbs down. You know, we're here to help you in best ways possible. We like the feedback. Share, share, share. We say sharing is caring. And we'll see you on the next one. Bye for now.